Welcome to the second quarter Wespath webinar. My name is Joe Halwax, Managing Director of Wespath's Institutional Investments team, and I'm coming to you from our offices here in Glenville, Illinois. For the last 5 quarters, we've done this event from our homes, me with my 20-pound cat named Moose, and Karen with her dog Polly. But we are slowly phasing back into the office, and excited to see our Wespath colleagues again, also looking forward to seeing our clients again this year. Today I'm going to cover our work in sustainable investments with Jake Barnett, update you on the markets, the performance of our funds, and close it out with an economic update from our Chief Investment Officer, Dave Zellner. First, I want to note that we have a newly elected General Secretary, our Chief Legal Counsel, Andy Hendren. Many people on this webinar know Andy as he has frequently spoken at our events, and he'll be working with Barbara Boisjegrain over the next 6 months to transition in 2022. Congratulations, Andy. We also have 2 staff announcements. Peter Chihuahua has joined the private markets team, having previously worked with our positive social purpose lending program. Also, Kate Tallow has joined Wespath as an investment coordinator. Congrats, Peter, and welcome, Kate. With me now is Jake Barnett to talk about our recently released Sustainable Investment Report.
Thanks, Joe. So this most recent Sustainable Investment Report covers Wespath's work to support the transition to a sustainable global economy in 2019 and 2020. This report has been in the works for the last 6 months and showcases the stellar work of the broader Wespath team. A special shout out to our communications department who put this together. I will give some brief highlights today from the report, but in the meantime, I encourage anyone who is interested to check out the larger report on our website and to scan the QR code on the slide right now. So today, let's talk about 3 highlights from the report. The first is our continued work to support a transition to net zero in the broader economy. In this report, you'll hear about our success engaging specific companies like Chevron and Occidental to encourage them to take more climate action through collaborative engagements such as the Climate Action 100+. You will also hear about newer efforts such as our role co-leading the asset manager engagement track of the Net Zero Asset Owner Alliance. The second highlight is our work on COVID-19 in 2020. One example of this work within our investment division is that we reached out to all asset managers that we work with, encouraging them to take deliberate and swift action to support an equitable and speedy recovery, with multiple managers responding that they incorporated some of our suggested best practices into their strategies. Additionally, as part of the broader Wespath team's response beyond the investment division, we generated $14,000 in charitable contributions to organizations responding to both COVID and racial justice issues in 2020. Finally, a very notable milestone that is celebrated in this report is the 30th anniversary of the Positive Social Purpose Lending Program. Please check out the report to see more about the evolution and impact of the PSP program over this time period.
Yeah, thanks, Jake. It's a great and robust report. How would you suggest that people use this report?
So I would have a couple of suggestions for those of our clients who seek to leverage this report to communicate with their stakeholders or to just show people the work that's happening at Wespath. The first would be to feel free to highlight specific sections that resonate with the community you are seeking to connect with. For example, we know that the opioid crisis has unfortunately hit some United Methodist communities particularly hard. And so those groups may be most interested in hearing about our work with the Investors for Opioid and Pharmaceutical Accountability, which is featured in the Sustainable Investment Report. The second point that I would make is to take ownership of these stories and sharing them with stakeholders. All of this work occurs on behalf of our beneficiaries and institutional clients. But in my experience, many constituencies don't have a full understanding of what they are enabling and supporting through their investments with us. These stories are your stories too, so please feel free to take them and tell them broadly.
Great, thanks, Jake. It's a wonderful report, and we're happy you could join us today.
Thanks for having me.
Welcome to the market update for the second quarter. It's amazing to think of how rapidly the world shut down and changed for the worse in February, March of 2020, and also amazing how rapidly we have recovered. Without dating myself, I'm old enough to live through a few pivotal events like 9/11 and the great financial crisis of 2008 and 2009. But I've never seen the speed and the change of mood from fear and pessimism, then switch back to extreme optimism in the last 12 to 15 months. Contrasting to the dystopia of March 2020 with the euphoria of July 2021, it's just amazing. And it's really the change over the last 6 months, which has much to do with fighting COVID and vaccines. Let's look at a few data points on COVID, which we believe is the main driver of optimism, the economic surge, and the subsequent rally in asset prices. Borrowing a chart from our friends at JP Morgan, looking at the chart on the left, the blue line represents the 7-day moving average of confirmed COVID cases. This peaked at 260,000 in January and has fallen to just 15,000 by the end of June. The black line represents deaths, which has fallen in a similar sharp manner. This is at least in part driven by vaccines, and at the end of Q1, 19% of the US was fully vaccinated, compared to 55% at the end of June, from 19 to 55% in just 3 months. Other countries are catching up quickly. Europe was lagging the US, but is catching up, with the European CDC reporting that those with one shot of vaccine in ages 18 or older, this has risen from 14% on April 5th to 62% as of June 27th. Canada was near 10% to start the quarter, and now has 68% of the country aged 12 and older with at least one shot. Again, this is a tremendous increase, which has driven the global economy, which Dave will touch on shortly. The increases in vaccines and decreases in COVID cases, combined with low rates and fiscal support, has been a very good backdrop for asset prices. Let's look at market returns for the quarter and for the year, where we see strong performance across the board. You're going to hear us talking about three themes: low rates, stimulus, and reopening as drivers for asset price movement. Looking at the top, the best performing index has been the Wilshire REIT Index, up 12.75% for Q2 and 22.7% for the year. The REIT sector benefits from all three themes just mentioned, and additionally benefits in a low yield environment when investors are looking for higher yield options. The Russell 2000, or small cap index, has also seen strong gains of 4.3% for the quarter and 17.5% for the year. Small cap stocks are historically pro-cyclical, benefiting from the reopening, given the higher percentage of names in financials and industrials, and less in technology. This is the 9th straight month of positive gains in small caps, the longest streak since December of 1986. The MSCI SMID Cap Index is just behind the Russell 2000, and the larger cap S&P 500 is trailing the small and the mid-cap space by roughly 2% on the year, but has performed better in the month. Looking at international markets, the MSCI XUX Index was up 5.6% on the quarter and 9.5% on the year. Strong numbers, but still lagging behind the US. The MSCI Emerging Markets Index is slightly lower at 5.7% and 8.8% on the quarter and the year. Why does the US continue to outperform international emerging market indexes? Let's go back to the three themes. First, rates. They may be lower in other parts of the G10, but they're low globally, so that's basically neutral. With stimulus, the US has been aggressive with fiscal stimulus as a percentage of GDP. And importantly, we must consider that to start the year, we expected a divided Congress. Once the Democrats swept the Georgia runoff, the expectation has been and remains for more stimulus. This supports US assets. Third, reopening. The US has led the world in vaccines and reopenings, with the exception of maybe Israel. But this helps explain the current outperformance year to date. As the rest of the world gets vaccinated and their economies return, we expect this advantage for the US will dissipate. Also, it remains to be seen in the US if we will keep fiscal spending at the rate we've seen over the past year. In other words, some of the drivers of US outperformance are expected to diminish in the second half of the year. I won't spend a lot of time here, but this is the Fed's balance sheet, and there are plenty of questions, including ours, on why the Fed continues to expand the balance sheet at such a pace when the economy is opening up and surging higher. We expect that the Fed will announce a tapering of the balance sheet as early as the Jackson Hole meeting in August. Looking at the U.S. yield curve, it helps explain fixed income performance for the quarter and the year. The bottom line is 1 year ago, at the end of June of 2020. The top line is the end of Q1 of 2021. So we saw a significant shift higher in the yield curve and a steepening. That's on the back of expectations for vaccines, higher growth, and higher inflation to start this year. In the second quarter, you can see that the curve has shifted lower and is slightly flattened. This is represented by the blue line. This reflects peak expectations of inflation near the end of March. It also reflects lowered expectations of stimulus, and also that the Fed has become slightly more hawkish, which would weigh on growth and inflation in the future. Switching gears to fixed income and commodities, remember a year ago when oil was $20 and gas was $2? Well, that's gone, as normalcy has returned and demand has returned with a vengeance. At the top is the Bloomberg Commodity Index, with the majority of the rally that we're seeing in energy prices, and this is something that we're all experiencing. Looking at fixed income, remember in the first quarter, we saw rates rise, which resulted in negative returns for most of the bond market except for high yield, which saw positive returns as spreads tightened. As I noted earlier when speaking about REITs, investors have been reaching for yield all year, which has resulted in spreads tightening across the board. Remember also that the 10-year yield peaked at 1.74% at the end of March. And as yields fell in Q2, the inverse relationship with bonds led to higher prices and stronger performance. The high yield index was up 2.7% for the quarter and is now positive by 3.6% on the year. The emerging markets index was up 3% on the quarter, which takes the year-to-date return to a slight negative of 59 basis points. Again, we saw in Q2 that the riskiest parts of the fixed income sector were the winners, and this is in high yield and emerging markets. This all lines up with what we noted earlier as the drivers: low rates, fiscal support, and the combination of lower COVID, vaccines, and economies restarting. This has driven investors to the riskier parts of the market. In the next segment, we will look at Wespath fund performance. Let's look at how the performance of the markets impacted the Wespath fund returns. With that, I will turn it over to my colleague Karen Mansko for the update.
Thanks, Joe, and thanks, everyone. I'm going to start off the performance discussion by first talking about our flagship balanced portfolio, the Multiple Asset Fund. As a reminder to our viewers, the Multiple Asset Fund has a long-term strategic allocation to 65% equities and 35% fixed income. On the slide, you can see the allocation the Multiple Asset Fund has to each of the individual Wespath funds. Also, what I like about this slide is that it really showcases the broad level of diversification the Multiple Asset Fund offers our investors. The next chart shows the net of all fee performance of the individual Wespath funds versus their respective market indices. Today, I'm going to focus on the second quarter performance and also highlight the one-year fund returns. Before I dive into the results, please note the returns we are showcasing are net of all fees, and the benchmark we measure the performance against does not have a provision for fees. Despite having positive absolute performance, the Multiple Asset Fund underperformed for the quarter by a modest 79 basis points net of fees. The underperformance was driven by the performance of our U.S. equity fund, which comprises 35% of the Multiple Asset Fund. And I'm going to talk more about the specific drivers of the quarter underperformance for this fund in a moment. For the quarter, the International Equity Fund and the Fixed Income Fund both outperformed their benchmarks by 5 basis points. Despite the Inflation Protection Fund underperforming for the quarter, the fund's absolute returns have outpaced the Fixed Income Fund for the quarter, year-to-date, and one-year time. Despite the near-term underperformance by the Multiple Asset Fund, the fund is outperforming its benchmark net of all fees by over 2.5 percentage points for the 1 year. The strong relative outperformance for the 1 year has been driven by the collective outperformance of each of the Wespath funds that you can see on the slide.
Karen, I know we typically show the performance of the Multiple Asset Fund versus a peer comparison of foundations and endowments that are custodied with our custodian BNY Mellon. How did the Multiple Asset Fund fare relative to this comparison?
The information on the slide that we are showing is updated through May, since the June data is expected to be released later on this month. But looking at the information, specifically the 1-year time horizon and longer, the multiple asset fund has outperformed the median foundation and endowment portfolio and performed in the top quartile for the 5 and 10-year time horizon.
So Karen, moving on, why don't you tell us how the individual fund contributors and detractors for the quarter?
So starting with our multiple asset fund, I talked briefly about the performance on this slide, but as you can see, the primary driver of the fund's underperformance for the quarter was the underperformance by our U.S. equity fund and the slight underperformance by our inflation protection fund.
So I mentioned during my comments that we continue to see strong performance in the broad markets with large cap stocks leading the way for the quarter, but they're still lagging small cap stocks year to date through June. Also, we saw a rotation that started at the end of the fourth quarter where value was outperforming growth. I know this is dissipated in Q2, but value still has strong returns for the first 6 months of the year. How did this impact the U.S. equity fund performance?
You're absolutely right. It really has been a value versus growth story this year, which is much different than what we saw in 2020 and even in the years before that. A reminder to our viewers is that the U.S. equity fund has a long-term strategic bias to underweight large cap stocks and overweight small and mid-cap companies. The fund also has an allocation to private equity and private real estate. So despite the fund's small and mid-cap growth overweight contributing to the performance for the quarter, as we saw growth stocks outperform value during this time period, the fund underperformed by 2 percentage points. The fund's underweight to large cap growth was a detractor, but the primary driver to the fund's underperformance was really the underlying stock selection by our investment managers. The names that helped the portfolio last year and even in the years prior were out of favor with this shift that we saw in the market cycle. So for instance, companies like Tesla and Teladoc that all performed very well in 2020 and even in prior years were down for the quarter. Last, we always like to report the impact of our ethical exclusions and that they have on the fund performance. So for the quarter, the fund's defense exclusion modestly contributed to the fund performance. Turning our attention to our international equity fund, this fund outperformed its benchmark by 23 basis points gross of fees. The primary driver to the fund's outperformance was our allocation to international private equity and the underweight to developed international markets. A detractor to the fund's performance was the alcoholic beverage exclusion, but that impact was minimal.
Now, Karen, emerging markets outperformed developed international markets in the quarter. I recall in prior updates that the fund had an overweight to emerging markets. Does the fund still have that overweight, and how did that affect fund performance?
You're correct. In prior quarters, the fund has had an overweight to emerging markets, but this overweight has diminished, and the reason is that China A shares were added to the index last year, which increased the index allocation to our emerging markets. With this said, our allocation in the fund did not adjust, but the allocation increased in the index due to the A shares being added. So with this said, the fund's allocation to emerging markets is relatively in line with that benchmark allocation.
All right, so moving on to look at bond funds performance, I noted during my market update that bonds have improved in second quarter despite a rocky start to the year with yields and rates so low. How did the fixed income fund fare with the improved performance by bonds?
It's really been a challenging year for bonds, with the exception of high yield bonds. As you showcased earlier, high yield bonds are up over 3.6% year to date, with the other bond asset classes in negative territory. But during the quarter, we did see yields come down, which was positive for high yield bonds and also the other bond sectors, such as treasuries and investment grade. I think it's worth noting that also the US dollar depreciated relative to emerging market currencies during the quarter. With this said, the fixed income fund outperformed its benchmark by 17 basis points for the quarter. The primary contributor to the fund's performance was the fund's allocation to emerging market debt and issue selection by our Core Plus manager, PIMCO. PIMCO's allocation to non-agency mortgage-backed securities, investment-grade industrials and financials contributed as we saw the tightening that we saw in the quarter. Also, PIMCO's selection in dollar-denominated emerging market issues contributed. Last, the fund's allocation to investment-grade credit was a contributor to the performance. Detractors to the fund's performance include the modest allocation to cash and also the overweight allocation to global bonds, specifically developed market.
So moving on to our final fund, the Inflation Protection Fund. You noted on the performance slide that the Inflation Protection Fund has outpaced fixed income fund on an absolute basis for the quarter, year to date, and even 1 year time frame, but modestly underperformed for the quarter.
So despite the modest underperformance, the Inflation Protection Fund has really showcased its purpose this year as being a fund that was created to protect investment portfolios against unanticipated inflation while providing that stream of income. The fund underperformed by a modest 13 basis points gross of fees. So despite the fund's underweight to global and UK inflation-linked bonds contributing to the performance, the fund's allocation to senior secured loans, which are not in the fund's benchmark, detracted due to that shift downward in the yield curve, which caused senior rates to also fall. Also, the fund's overweight allocation to U.S. TIPS also detracted.
Great, Karen. Thanks for that update. Welcome to the Wespath second quarter economic update. I want to start, Dave, by referring to your monthly investment report for June. You reported that inflation was 5% for May, and you also reported that there's a debate regarding whether this current surge in inflation is temporary or what some refer to as transitory. So what are your thoughts regarding this bout of current inflation and how long it will last?
Yeah, Joe, to answer your question, I presently fall in the transitory camp. Though I do think we will likely see elevated levels of inflation at least through mid-2022. As we know, the Consumer Price Index rose 5.4% on a year-over-year basis in June. This follows May, when the CPI jumped 5% year over year. To demonstrate why I think it's transitory, I would like to start by looking at the components that make up the U.S. Consumer Price Index. As you can see in the first chart, housing and food comprise 60% of CPI. Note the transportation sector on this chart. Products and services such as automobiles, gasoline, and airfares made up just 13% of CPI at the end of 2020. So let's now see how price increases affected select elements of CPI in May and June. This first chart looks at several of the major components of the index: the cost of housing, food, medical care, education, and communication services. Note that price increases in May were somewhat subdued at 2.2% for 3 of the 4 categories and only 1.5% for medical care. While it is true that we saw a boost for 3 of the 4 categories in June, the numbers we see here are a far cry from the 5.4% year-over-year increase in the CPI for the most recent month. So you may ask, what caused the spike? Well, this next table reveals the sizable price increase that we saw for the transportation sector in both months. Of course, we all know that prices for these products and services cratered at the onset of the pandemic. 1 year on, prices are returning to pre-pandemic levels. Now, in fairness, gas prices are higher than they have been in 7 years. And further, the automobile sector has experienced 2 idiosyncratic events causing a shortage of new cars and a spike in used car prices. First, the world is experiencing a semiconductor shortage attributable to a confluence of various events. Second, the rental car industry, which is the biggest supplier of used cars, sold the bulk of its cars last year at the onset of the pandemic and have begun rebuilding their fleets. So even though the transportation sector makes up just 13% of CPI, the big price increases that you see in this chart accounts for 3 full percentage points of the 5 and 5.4% increases in May and June. Now, I think the last chart on the slide illustrates the market's expectations for inflation have modestly retreated from earlier highs, though it is still expecting about 2.5% inflation for the next 5 years, which is about a 0.5 percentage point higher than the Federal Reserve's target.
So then, Dave, you don't think that this current spike will persist, correct?
You know, I don't, but as I said, I do think it's likely that we could see higher levels of inflation for about another year.
Yeah, Dave, but what about labor costs? Don't you think that that will continue to drive inflation higher? So, for example, there's a lot of talk about labor shortages. As the press reported last week that McDonald's in some states are raising minimum wage to upwards of $20 an hour. So don't you think that increasing labor costs will continue to drive increasing inflation?
Yeah, well, Joe, there's definitely a labor shortage and wages are clearly going up. This first chart shows that there are currently jobs that have not been filled. It's for over 9 million workers. And the chart on the right shows a survey of small business owners who say they've never had more difficulty finding workers than compared to today. And so the labor shortage is in fact real. Now, on this next chart, Joe, we see the labor participation rate. In other words, it's the percent of the working age population that have or want to have a job. The rate is well short of pre-pandemic levels. And here we see in the chart on the right that job growth affirms what we saw on the previous slide. The economy is short of nearly 10 million workers. So this next chart affirms what you were alluding to, Joe, when you asked your question. Wages for production and non-supervisory workers are up about 4.5%. Now, I would ignore the spike you see in 2020 as there were some anomalous factors at play, notably an economy that shut down and laid off a lot of lower paid workers in the hospitality sector. But this next chart reveals that we are seeing productivity increases. To me, this is not a surprise given the rapid increases we've seen in technology. But more important, we are seeing productivity gains from work at home, the work at home phenomenon. We've all heard the stories about how employees have experienced improved productivity since we went into lockdown a little over a year ago. Now you may ask, Joe, what productivity gains have to do with inflation? Improved productivity means less labor goes into making a product or providing a service. Hence, improved productivity partially offsets the inflation effect of higher wages. I do think that we are likely to see elevated productivity levels for the next several years. Now, I have one more comment, Joe, before we leave this topic. Up until the pandemic, for the most part, location has constrained employees and employers. The perfect employee for an employer in, say, Jacksonville, Florida, may be living in Asheville, North Carolina, and unwilling to move. The employer in Jacksonville may hire a less than perfect employee living in Jacksonville, and the employee in Asheville may go to work for a less than perfect employer in order to stay working locally. Now, the work from home trend, though, is going to be a game changer because it allows for that perfect match, which will have major implications for productivity.
So Dave, another topic that's been in the news a lot lately is related to the inflation theme, and that's the cost of housing. So a data point that you highlighted in the monthly investment report was that housing costs rose the most in 33 years. So what can you tell us about housing?
So April saw the highest year-over-year price increase in the nearly 35-year history of the Case-Shiller Index. And as you can see in the chart on the left, labor and materials shortages have also adversely affected the housing situation. That said, we have seen some recent signs that the housing shortage is beginning to abate. The one consolation is that the mortgage rate for a 30-year mortgage is still below 3%.
So Dave, what about near-term economic growth?
Well, retail sales are strong, as you can see in the chart on the left. Sales are running way ahead of trend, though clearly due to the unprecedented fiscal stimulus that we've seen from Congress. The dotted purple line in the chart on the right shows that it just took 6 months for retail sales to match, then exceed pre-pandemic levels. This contrasts with the blue line, which shows that it took 3 years for sales to recover coming out of the Great Recession that began back in 2008. The elevated levels of sales have led to inventory shortages, as you can see on the chart on the left of this next slide. The chart on the right displays forecasts for economic growth in the second quarter. We will get a first reading from the Bureau of Economic Analysis in about a week after we post this webinar. Consensus estimates are for about a 9.5% growth in the second quarter, though the Atlanta Federal Reserve is a bit less optimistic than their consensus. They're forecasting about 7.5%.
So Dave, how sustainable is this current surge in retail sales?
Yeah, I don't think anyone believes that sales will continue at the current pace, but as we saw in a prior slide, the torrid pace of sales combined with supply shortages have drawn down retail inventories. Building those inventories back will support growth at least into 2022. So growth should be strong well into next year, absent uncontrolled variants of the virus. Also, my thesis about inflation could be wrong, and the Fed may be compelled to act because inflation is too high if it thinks it will remain high, absent any action that it takes.
So I imagine this robust consumer activity has been good for business. So what can you tell us about current business conditions?
Yeah, Joe, it's certainly been, and purchasing manager activity recently has set records. And while purchasing managers have seen some scale back from spring's level of activity, business for both manufacturing and services remain robust. As one might expect, this is translated into higher corporate profits across the board. While a jump in first and second quarter profits are no surprise to anyone, given the effective shutdown of the U.S. economy last year, no one expected the magnitude of the bounce back that we see on this chart for the first and second quarter.
So you just showed that manufacturing and services activity is strong in the U.S., but what about Europe and the rest of the developing world? I mean, aside from the UK, the U.S. has led the world in vaccines and vaccinating our population, but we know other countries have not been nearly successful. So what is business activity like overseas?
You know, actually, Joe, activity is really strong in Europe despite their slowness in vaccination. The recent months are very green on this chart with generational purchasing manager bullishness for all of Europe. And you are correct that some of the developing countries have been struggling. But manufacturing activity has certainly recovered, though it's not nearly as strong as what we just saw for Europe.
So Dave, you often talk about emerging markets and Wespath's investment belief that the world will experience modest and sustainable growth led by emerging markets. But as you just mentioned, the emerging world has fared poorly during the pandemic, with Brazil and India particularly hit hard. So has your thesis about emerging markets changed at all?
So, Joe, in answering your question, I do want to start by looking at about 70 years of history of U.S. economic growth. So I've shown versions of this chart before, and up until the 21st century, economic growth was consistently between 3 and 4% in the United States. But long term, there are only two factors that will account for a country's growth. They are the growth in the workforce and productivity improvements. This chart shows that we've had steady growth in workers through the end of the 20th century. But in the last 20 years, worker gains have been modest, and the future doesn't look good. The chart on the right shows that the U.S. isn't having enough children. We need to average 2.1 kids per woman for each generation to exactly replace itself without needing international immigration. Now, fortunately, as you know, there are a lot of people wanting to come to the U.S., so attracting sufficient numbers of immigrants shouldn't be a problem. But we need that to at least maintain the current size of our workforce. But I do think it's fair to say that any growth in U.S. GDP has to come from productivity improvements. And I talked about that earlier, how I think we are going to see productivity improvements going forward. And further, as I think we all know, the prospect for workforce growth is far worse in Europe and Japan than it is in the U.S. Hence, I think it's reasonable that the developed world can't possibly hope to consistently achieve 2% long-term growth rates, and most observers agree with that. The developing world, however, still has a long way to go growth-wise. So I've shown this first chart before, which is the extent to which the developing world will see a growth in the middle class. However, the chart on the right looks at middle class growth from a different angle. Over the next 10 years, there'll be 1.5 billion new middle class in the developing Asian market. And this compares to only about 175 million for the rest of the world. These 1.5 billion new middle class will be buying stuff. And we at Wespath want to be positioned in the companies that will be selling that stuff to them.
Well, Dave, thanks for that update, and we look forward to hearing more of your thoughts.
Very good. Thank you, Joe.
This concludes our webinar. Thank you for being with us today. If you have any questions, please email us at investmentinfo@wespath.org.